What's up, guys? Welcome to the GrowingAU Show. Hope you're all having a very highly successful day. You don't have to look very far recently to see how crazy the market has been. I know we talk about the roller coaster ride all the time, but really we're going to be talking about it again today and a possible warning for investors and what I think you need to be doing in these volatile times. We talked about it a little bit last week, but I think as things continue to get a little bit more kind of scary out there, the more we need to keep addressing this to make sure we're all on the same page and really stand to continue to benefit in the market as investors. So we're going to be talking about that today. Let's roll the intro and jump on into it. So I've been doing some research, I've been doing some reading, I've been looking around at different articles, talking about the market, talking about individual assets, planning videos. That's what goes into it, reading a whole bunch of different stuff. And as I've been reading a lot, the kind of scarier it gets. Updates from the Wall Street Journal every day, reading and watching the numbers in the Dow Jones, the S&P 500, watching these things, reading stuff from MarketWatch.com, Motley Fool. There's a lot of people that kind of seem worried about there, and really a lot of highlighting some of the really volatile parts of the market, seeing a lot of active day trading, a lot of retail investing, and things that are just causing numbers to fluctuate rather aggressively. So there's been an article that I read, and part of an article talked about some really fears we need to be looking at in the market. I'm going to read those fears for you right now. They worry that if the pandemic gets worse, it may trigger a reversal in the reopening process. Monetary or fiscal fatigue kicks in as central banks run low on automation and further rounds of government stimulus fail to impress. And business and personal spending doesn't rebound as much as expected, and bankruptcies take a heavy toll. Retail investors and day traders and even long-term investors from putting their money in the market saying that a lot of people are still buying the blue chip stocks. However, it has led to a wide degree of volatility of the market and a lot of speculation. And I think right now I've had a number of people reach out to me talking about, I'm looking to get started investing. I'm looking to begin to put my money in the stock market. Is it a good time? Should I wait? Should I bite the bullet? What is going on? And I want to address some of that today. It is ridiculously crazy. And I think it can be very easy to get overwhelmed thinking, oh, I shouldn't put my money in. I shouldn't have put my money in. I should sell out now. I should liquidate my assets. Maybe I should buy in more. Should I buy, cheap stocks that might rise? What's the deal? Well, first of all, I think if you had developed any sort of financial or investing plan before all of this craziness began to happen, I don't think simply following it is the wrong answer. I think you have every right to continue to stick to that plan. You clearly made that plan for a reason, and I think to simply switch that plan because things get crazy may not necessarily be the best choice. I think right now it's time to be thinking about the long term, which you might be thinking, it's so volatile right now. Why would we want to think about the long term? Well, look at this graph right here. This is the S&P 500 over the last 90 years. You can see some very significant dips, including the dot-com crash, including the Great Depression, and the 2008-2009 financial crisis. We can see some very serious dips in those moments, and in another 5 to 10 years from now, you're going to see another very serious dip where we currently are. But you can also see after every single one of those points, we've seen a very significant rebound. The S&P 500 continues to grow, and really every single downturn has been followed by an upturn. So what I'm saying is we need to be thinking, yes, right now it's crazy, right now it's volatile, but what's it going to be in 5 years from now? What's it going to be in 10 years from now? What's it going to be in 40 years from now? Because ultimately, as you know, that is a type of investing that we promote on this channel. We want to be talking about long-term investing, the long-term accumulation and growth of wealth, not quick-term and turnaround trades that could release profits in the short run. We're talking about long-term investing here. I think right now is the time to continue to invest, to continue to follow your investment strategies with the long-term in mind. So what does that look like for the investor that's just starting? Well, for anyone who's just getting into the market, I really have three major suggestions, 2 things that you should buy and 1 thing that you should avoid. I would not personally right now go in and start investing in companies like Hertz, companies like Whiting Petroleum, companies like Chesapeake Energy, companies like Genius Brand, these companies that we have seen, really quick pops in their value, companies that have gone bankrupt that we think may have a potentially higher value in the future, these companies that we believe to be incredibly possibly undervalued, and we see a lot of retail investors going into those companies to try and get the returns that they may think come in the future. I would not recommend going into these companies. I don't think it's necessarily safe investing. I think there are probably way better places and far safer places, less risky places to place our money, and that's what I would consider doing. I would not look at investing in any of those companies in the effort to make a quick buck in the short run. There are far safer places to put your money. So with that being said, where would I recommend putting that money? Well, it comes down to 2 major places. I would say blue chip stocks are still a good choice. If you want to buy individual assets, if that's what you're interested in doing, blue chip stocks, I think right now are the way to go. There's a good chance you'll be able to get some of those blue chip stocks for a very relatively decent deal, but we still know that those companies are reputable. I do understand that for a lot of us that are investing and starting investing, we may not have a lot of money to spend, so buying $300, $400 worth of one share might be kind of a bit over budget, but I think finding those blue chip companies that are affordable to you is the way to go. Companies that have seen very consistent growth over the last 5 years, companies who have a very strong brand association with their name, I think are the way to continue to go right now if you want to buy individual assets. That being said, I think another really smart thing to do right now for investors who are just starting in the market, this is a good time to get into index funds, ETFs, and things that are just going to track the indexes. That way, you're not risking losing a whole bunch of money if the individual asset you buy goes out of business. The S&P 500 doesn't go out of business. Investing in an index fund that tracks in S&P 500 or investing in an ETF that tracks the S&P, I think both of those things are going to do really, really well for you. After all, you'll track it. It might go down now, but the S&P, as we've seen by that 90-year graph, is going to continue to rise into the future. And I think doing that is something that would be beneficial to you right now if you don't want to risk money in individual assets just because it's so volatile and the hardships on businesses right now are numerous. So right now, investing in those index funds, investing in those ETFs, I think would be a very smart way to go. After all, the more diversified your portfolio, the less risk you have. At a normal growth rate of 6 to 8%, that's going to be way better than you're going to have with your money liquidated sitting in a money market or savings account. So that's another thing I'd really recommend doing, looking into ETFs and looking into index funds right now, because even though the market's volatile, it's a great way to still get started investing without the potential of losing your money to a bankrupt asset. Overall, I think this is a time to stay the course. Understand that things will improve in the future. Buy blue chip stocks, buy things that have a lot of value behind their name, valued companies, value investing, all that type of stuff. Invest in index funds, invest in ETFs, things that are going to continue to grow in the future and that track the overall market. We really want to be focusing on lowering our liability, lowering our risk at the moment when the market is so risky. I do not think this is the time for the long-term investor. I do not think this is the time for the new investor to be looking for a quick buck in companies like Hertz. Is it possible they can return in the future? Absolutely. We don't know if they will or if they won't. But for us who are going to be focusing on the next 10, 20, 40 years, there are bigger wins in the future down the road for us. Don't be worried about the little stuff like that. And I will say really quickly, even though it is an incredibly volatile time, if you want to try to make more sense in the market, feel like you have more knowledge on your side to work with, check out the resources in the description below. We have a whole bunch of books listed and affiliate linked in the description below that are going to allow you to really get a leg up on the market simply by increasing your knowledge. I really would highly recommend them. Definitely check them out. And if you do check one out, drop us a comment. Let us know what you're reading, and that'll definitely help you moving into the future in this volatile time. It is crazy out there right now, but I do believe that bright days are ahead. After all, this graph basically proves that. So I do wish you all the best with your investing plans. As I said, blue chip stocks, high valued companies, and really just if you don't want even that much risk, go with those ETFs, go with those index funds. More on that in the Common Sense Investor. We do have a review coming on that very soon, but if you do want to read the whole book, that will also be linked in the description below. Appreciate every single one of you. Drop us a like if you enjoyed. Make sure you smash that subscribe button, and we will catch you next time.